You got to keep on kind of doing those tax projections and doing the projections of the stock, over, a long period of time.
What's the number one secret to maximizing after-tax cash flow with these IPOs? Let's talk about that.
Well, the secret, the secret is you need to start planning well before the IPO process starts. And a lot of people, when they go into, a new company, whether it's working, whether it's investing in it, they don't take the steps they need to do on day one. That's going to help them immensely down the line. So, for instance, there's a lot of people fail to make 83B elections on their stock, and so what that means is that they get taxed over time rather than upfront, when the tax would be much lower. And so the secret is you got to keep on kind of doing those tax projections and doing the projections of the stock, over a long period of time. And you can't forget about it and just say, okay, well, these options exist, but my head's down, I'm at my job, which is understandable. And I'm just going to ignore these stocks until I have to do something with them. And then by that time, it's too late. There's not a whole lot you can do.
So give me an example. So, okay, I'll give you an example, and you can let me know from there. So I have a brother-in-law who works at Acorns, right? Has 5,000 stock options at 92 cents, right? They're set to IPO if they haven't already, here soon. And, they're going to go, I don't know, $20 a share, right? Now, this is a smaller case, of course. And I'm just kind of making some stuff up. But so what does he need to do in order to walk me through the process?
Yeah. So again, I don't know when your brother-in-law started, but if he started 3 years ago, when the valuation of the company when he started was 92 cents, it's possible. Again, different companies have different rules. So again, it's hard to make general statements when every company has its own stock plan. But assuming that he could have, let's say, early exercised the stock, and by that I mean purchased the stock before it technically vested, the difference between the valuation and what he paid for it would be zero. Okay. So then what happens is, you could tell the IRS, essentially you have to pay the 92 cents a share to the company before you actually vest those shares. You tell the IRS, hey, by the way, I did this, and I want you to tax me on the difference between the strike price and the fair market value, which is zero. So you pay zero tax up front, but you have to pay, you buy the shares. As those shares are vesting, right, the value has gone from 92 cents to $1.50 to $3, and it keeps going up over time. When that happens, and when they vest, when you should get the shares, you don't get taxed on those shares because you're already paid the tax already, because you told the IRS, hey, tax me on this. Now, when you go to sell them, you're going to owe the tax, but you don't have to pay the tax incrementally along the way. And that could save you some money, especially if we're talking about non-qualified options. The delta ends up on your W-2. And, as you know, offsetting W-2 income is very difficult. Yeah. And so if you're, if it was included in his W-2 over, the last 4 or 5 years, by the end, he could have, again, it's 5,000 shares. It's not 50,000 shares, but again, the higher the number, the more valuable it is. You avoid paying tax later on for W-2, and you get to move that all into capital gain, which can be offset a lot more easily than W-2.
Right.
So, again, that's something that you have to do it early on, and you have to have foresight, and you have to have a little bit of cash, and a little bit of luck, because if it doesn't work out, you're not going to be happy.
So there is an absolute risk involved with doing this particular strategy, because if the company that's a startup goes belly up, then you're left with these shares that you've already purchased that are essentially worthless. Now that you could probably take those and do like a tax loss harvest or something like that, and try and manipulate it for the future. But yeah, it sounds like you have to really be confident in your company that it's going to go.